Hello and welcome to Money Tips. This is Charles Kelly. Is your money safe in a peer-to-peer lending platform? In other words, if you give your money to a peer-to-peer lending platform, which is a scheme that puts you, the investor or the lender, in touch with the borrower and takes a commission for that, and it basically cutting out the banks and then pays you a higher interest rate than you would have earned from the bank. That's a peer-to-peer scheme in essence. But is your money safe in these schemes? Well, they say it's safe, don't they? Obviously, they say, we only lend up to 70% typically. Your money is secure on a property. And, from that point of view, it sounds okay. So in theory, there should be very little money lost in these type of schemes. Now, some lenders may say that the defaults are very low, but I mentioned one a few weeks ago, which is a lender called Lendy that had a string of problems and actually went out of business. And now I see that there's another company in a few problems, which is called Money Thing. Money Thing raises funds for businesses. Now, this is interesting. Unable to obtain finance from traditional sources such as banks. Now, if that borrower is unable to obtain funds from a bank, there's got to be a reason for that. I mean, if the banks don't want to lend them, and there are lots of banks out there, why is that? And then you lending them money is a bit like the old loans that in the last financial crisis, when these loans made to people who were in default on their mortgages all went under. They were useless. They were junk loans, as they called them. These are these sort of adverse credit type of people, and these loans. I'm not saying that they lend to people with adverse credit, but they've obviously been unable to obtain finance from traditional sources, and so that would, to me, sound like a big alarm bell. And then investors had also been promised rates as high as 18% on their loan, fully backed by properties that can be sold if the borrower defaults. Well, that sounds all very, very nice. However, the company's website showed that in June alone, it had posted 14 default notices on deals and had a further 18 non-performing investments, which probably means that the borrower is not paying any interest or has defaulted on payments or is in arrears. So that's slightly worrying. In one example, a project that had been advertised as having assets worth 4.5 million was in default, and a note on Money Thing's website said that a property securing the loan had been sold for, wait for it, £2 million. So it was £4.5 million had been sold for £2 million, and of this, only about £850,000 had been distributed to the lenders, which is the investors, if you like. And that means that nearly 1 million of lenders' cash was still not recovered. So I don't know where that's going to come from. If the property's been sold, do they go after the borrowers personally? Do the borrowers have any other personal assets? Did they take charge on any personal assets? It sounds to me like this lender is not competent in the way it's lending out the money, and that's important for you because they are underwriting these deals. You don't get to underwrite them probably. They're the ones sort of recommending these deals. So another example showed that a development project did not have planning permission when the loans were issued, and it was now in default with about 64,000 yet to be recovered. And now, when the Sunday Times looked into these and asked questions about it, Money Thing said it planned to pay the investors, but it then tried to block the Sunday Times from going on their website and asking any questions. The company is apparently based in a semi-detached home in Whetstone, North London, and has raised almost, 38 million for firms since launching in 2014. And it says on its website, "We believe in transparency." That's the quote in the Sunday Times. Now, obviously, the peer-to-peer industry has grown quite rapidly over the last, decade, if you like, and it's drawn more than £10 billion worth of investment. So this has given the banks a run for their money. And peer-to-peer, there is a peer-to-peer finance association, helped by the record period of rock-bottom interest rates on savings, which has encouraged people to take more risks to beat inflation. Clearly, if you're only getting, say, 0.25% or even less than that, maybe half of that from the bank on deposit, and then someone else is promising you 18%, that's a huge difference. even 10% would be maybe 40 or 50 times what you would get from the bank. So that's a huge difference. So now not all of them offer that, and some of the more cautious of the lenders would typically offer you a return of 5%. But then to me, that thinks, well, 5% to risk my money, that doesn't seem worth the risk to me, just to get 5%. Now, you must remember here that there's no protection on peer-to-peer loans under the Financial Services Compensation Scheme. In other words, if you put your money in a bank, you would get losses if that bank, for any reason, did go into default, went under. You'd be covered by up to £85,000 should the firm holding your money go bust. Now, I can't remember the last time a major bank went bust in this country. Some of the challenger banks are under scrutiny. Yes, they could potentially go under, but I don't think the government or the country is going to allow one of the big four or the big five banks to go under, as they did. They rescued them in the last financial crisis. So peer-to-peers, because of that, have become under increased scrutiny by the Financial Conduct Authority after a spate of company failures. These include Lendy, which fell into administration in May, which I've mentioned in a previous previous podcast, and less than a year after it received full FSA authorization. So they're authorized by the FSA, but you don't get any compensation if they go down. Its investors are likely to incur millions of pounds of losses. And this month, the regulator announced rules limiting peer-to-peer investments to no more than 10% of an individual's investable assets, unless they receive regulated financial advice from I suppose, a regulated financial advisor. And the rule takes place in December, so it doesn't really help people who are already into these schemes. And Moneything said, this is the lender, that the details of these deals were not for anyone. Part of the terms and conditions for registering, it states that it expects defaults of 8% of its loans this year, up from 3% in 2015. It also says that while there have been no defaults, there have so far been no actual losses. Well, I thought there was a loss in that other deal. So I think you've just got to watch your be a bit cautious on this. Again, they say they only go up to about 70%, but that is all depends on the valuer they use and the valuer's opinion. So, one valuer can say, yes, this is worth X amount, but perhaps when a property is demolished or it's pulled apart, maybe it's not worth that amount. So, and then what is it worth on a forced sale value? I.e., if you had to sell it today at an auction, what is it worth? There's usually a big difference in that. Now, another high risk lender is, according to the Sunday Times, is Landlord Invest, where you can invest as little as £100, and they offer rates between 5 and 12%. Lower risk property-backed peer-to-peer providers include Fitzrovia Finance, offering rates of up to 5.5%, and Octopus Choice with advertised rates of about 4%. And they mention various company top rates: Octopus Choice 4.7%, Fitzrovia Finance offering 5.5%, the House Crowd 10%, Assets Capital 12%, Moneything 12%, Landlord Invest 12%, and Funding Secure 13%. So, I'm not saying don't invest in these deals, and I would certainly not, dissuade you from using peer-to-peer platforms, because they obviously are a good way of raising money. And it's a shame that some of these have perhaps not invested the money wisely, and the projects have gone wrong, because I think it's a good thing to have competition out there for the banks through things like crowdfunding, peer-to-peer, and other ways of securing money without necessarily going to a traditional bank. But just watch out for that, and be careful. The FSA are going to bring in rules about this, but I certainly wouldn't be putting all my money into a thing like this, because it is a bit of a gamble, and you're not in control of it as you would be if you were investing it into one of your own deals. So that's all for now. I hope that's been useful for you. This has been Charles Kelly, bringing you money tips to help you save, earn, invest, and accumulate more money. And if you want to know more about how to invest in property, then do contact me, because I have some exclusive complimentary tickets to starter property courses where you can learn properly how to find your own deals, how to fund your own deals, how to do JV partnerships where you can work with a joint venture partner, and how you can invest in property for no money down. Okay, so do contact me if you're interested in that, or click on one of the links below. Thanks very much, and speak to you soon.